Decision Exam Help. For any help regarding economics exam help, visit https://www.economicsexamhelp.com, email support@economicsexamp.com, or call us at +1 678 648 4277. 1. Decide whether each of the following statements is true, false, or uncertain, and give a brief but clear explanation of your answer. Most of the credit will be given for the explanation. 1A. Note: 1A, not covered anymore. The market demand for diamond-glazed skillets in quarter T is described by LNQT equals 3.60.643 ln, 0.231 ln, PCT, plus 1.12 ln, IT1, plus 0.646 ln, QT1, plus ET, where P is price in dollars, of a standard size skillet. PC is an index of other cookware prices. I is the average income of the wealthiest households, top 10% of the wealth distribution, and the T1 subscript denotes the previous quarter. The demand for diamond-glazed skillets is price inelastic. Note: you do not need to calculate logarithms to answer this question. Solution: uncertain. This is a dynamic demand equation. Note the presence of ln, QT1, on the right. The SR price elasticity is -0.643, so that demand is price inelastic in the short run. The LR price elasticity is -0.643/1.646 equals 1.82, so the demand is price elastic in the long run. Common mistakes: many students did not differentiate between SR and LR own price elasticities. The SR elasticity can be read directly from the given equation, while the LR elasticity can be calculated as indicated above. economicsexamhelp.com. Another common mistake was not defining, or incorrectly defining, the SR and LR elasticities as either elastic or inelastic. Elasticities are elastic when E1 and inelastic when E1. Some students discussed elasticities, such as income, other than own price elasticities, and some students misidentified price elasticity as 0.231/0.646 rather than as -0.643 SR. 1B. A startup U.S. biotech manufacturer purchases 30 heavy processing machines and may buy more as output increases. These machines are made only in Germany, but are widely used in the biotech industry. They have an average life of 10 years, and there is an active resale market. 2 years after this purchase, the U.S. imposes a 50% tariff on all imported equipment of this kind. All else equal, the tariff will cause the biotech firm's variable costs to rise. Solution: true. The machines represent a variable cost, as more machines will be acquired as the firm's output increases, and there is an active resale market for selling machines if the firm's output declines. The tariff raises the market value of the machines, and therefore raises variable economic costs. Common mistakes. The common mistake here was thinking that the machines would always be a fixed cost for the biotech company. Some people said that while they were probably fixed in economicsexamhelp.com. The short run: in the long run all costs are variable, so the tariff should be factored in. In addition, even in the short run, the tariff raises the market value of the machines, which implies higher opportunity costs, raising the firm's user cost of capital, which is a component of variable costs. The machines would not be sunk costs because there is an active resale market, and the higher market value means that the firm could receive a higher return than before if it chose to sell. Finally, as the question said, the firm could buy more if output increased, or sell them if output decreased, implying that it would be a variable cost. 1C. Your company lost a court case and has to pay $20 for every snowmobile it produces. The verdict cannot be overturned. That implies that this is a sunk cost and should not play a role in further decision-making. Solution: false. The $20 fee is charged for each snowmobile to be produced. It is a variable cost of production and is not a sunk cost. Common mistakes. The most common mistake was not realizing that the $20 fine per snowmobile was a variable cost rather than a sunk cost. Sunk costs are unrecoverable and should not influence future economic decisions. However, the $20 fine varies with output and does affect future decisions. If the manufacturer does not produce snowmobiles, the $20 cost is avoided. Alternatively, the manufacturer could increase the price of the snowmobiles to try to recoup all or part of the $20 cost. economicsexamhelp.com 1D. If you suspect the market for your new product could exhibit positive network externalities, it makes sense for you to price your product lower at launch than you normally would. Solution: true. If you suspect that your product will exhibit positive network externalities, you want to set price and quantity to reflect that an additional unit sold now will add to installed base in the future, which will increase future revenue. This means that current MR does not reflect all marginal revenue, and that current MR equals current MC will result in too low an output value. For example, in a two-period example, the firm should operate in period 1 such that so that for current values only, we have that MR1 MC1 so that for current values only, we have that positive network externality. Common mistakes. Most people answered this question correctly. Those that did not thought that price should be higher or that you should wait after the product launch to decrease price. For network externalities, you price where marginal cost equals the marginal revenue plus the future benefit, revenue, from production today. Thus, you want to decrease price at the launch to increase quantity demanded via the bandwagon effect, and reap higher revenues in the future. You need to consider the effect of future revenues when pricing today, which is why you should lower the price at launch. economicsexamhelp.com 2. Suppose that market for loaves of bread in Fredonia has demand D, P, equals 20,000, 1,000 P and supply S, P, equals 1,000 P, where P is price per loaf. A. What are the price and total quantity of bread supplied? What are the demand price elasticity and supply price elasticity at this price? Solution: the market equilibrium requires 20,000 to 1,000 P equals 1,000 P, which gives P equals $10.0. At this price, supply is 10,000 loaves. Price elasticity of demand equals B asterisk P/Q equals 1,000 times 10 divided by 10,000 is equal to -1. Price elasticity of demand equals D asterisk P/Q equals 1,000 asterisk 10 divided by 10,000 is equal to 1. Common mistakes. Most students correctly answered this question. A few students forgot to compute the demand and supply elasticities. Some other students forgot that the demand elasticity was negative. An increase in price results in a reduction in demand, while the supply elasticity is positive. An increase in price results in an increase in production. B. The government of Fredonia imposes a price band. The price of bread cannot be lower than $1 nor higher than $2. What are the new price and total quantity supplied? What is the deadweight loss? How much do producers gain or lose because of the price band? How about consumers? Solution: with the price band, the new price is at the price ceiling $2. At this price, supply is 2,000 loaves. economicsexamhelp.com